Welcome to Trading Nation. I'm Sara Eisen. Stocks are rebounding a day after Italy's political turmoil rattled the market, but could sharp gains stick? Wharton finance professor Jeremy Siegel is here with some answers. Welcome, Professor Siegel. Nice to see you.
Happy to be here.
So last time we talked to you mid-April here for Trading Nation, you were pretty cautious on the markets. Has anything changed?
No, it hasn't really changed. I think Italy is being overplayed. I don't think that's the major threat of the market. I still think the major threat of the market is higher interest rates going forward. I think that too many people read the FOMC minutes as being too dovish. I still think, though now I'm definitely in the minority, that they will hike 3 more times this year.
Three more, so for
hikes.
a total of 4. That's not the consensus.
That's no longer the consensus. Certainly moved sharply lower with what is going on, all the news from Italy, and that's sharply lowered that expectation. But I don't think that's going to do much for the strong jobs picture we have. I think this Friday is very important. Again, to see what's going to happen to the unemployment rate, what's going to happen to wages, and, of course, the non-farm payroll.
Why do you think the market is overestimating the impact of Italy, whether it's in financial markets or on Fed policy, given the last time this happened, about 7 years ago with Greece, it did provoke a pretty big market reaction for a prolonged period of time and led the Fed to change course?
Well, if you remember, actually, I was on CNBC 2 years ago when Brexit occurred, and I said that no other nation was going to leave the euro. I said if Greece didn't leave the euro, no other nation. That's the nation that really needed to, yet it didn't have the courage to do so. And despite all the posturing of the far left, far right parties, the Italian public did not want to leave the euro. I actually thought that Mattarella's dismissal of the president was not a good political move. I think the coalition probably would have collapsed on its own, but nonetheless, they wouldn't have left the euro. Now he just mixes up the populist feeling again, and we're going to probably get new elections and et cetera. But the truth of the matter is, the memories of the lira, there were thousands to the dollar. They inflated dramatically in the 1950s and 60s, and the Italian public has memories, or their parents have memories. They don't want to go back to that. And despite all the drawbacks of the euro, they rather stick with sound currency rather than go to another lira.
Do you not think that the trade tensions, which are proving somewhat unpredictable from the administration, will also impact financial markets and the Fed policy?
Yeah, absolutely. I mean, that is a wild card, and it has been a wild card for the last 3 months. I mean, the betting is still there's going to be a resolution without tremendous disruption. I mean, I do think that Trump is getting some negative feedback from some of his political support in the farm country, rural countries about some of the tariffs that have been added. He, I think, feels he has to tread very, very carefully on this. Doesn't mean for sure, he won't go full blast forward. But my feeling is that that caution's going to be the word here. Yeah. And of course, we have North Korea situation. He may have himself in a little bit of a bind there because I think he's got expectations of the public up, and he doesn't want to dash those either. With Trump, there's always going to be uncertainty into the mix. The thing that's positive is that he is pro-business. He is pro-low taxes, low regulations. And to the market, that's the most important thing.
So I'm going to pin you down here. We were just showing the S&P 2725. Do you have a prediction about where it's going to end the year?
Well, last December, I said it's going to be a tougher year, 2018 than 17. I said we're going to be 0 to 10%. I guess we're above 5 now. I actually haven't checked it. I think we could be just about in this range because not only are we going to have interest rates, I think, rising, as I said, I still think 4 rate hikes. We're going to have the political uncertainty. Midterm elections are less than 6 months away. Democrats are favored by the shrewd bettors to take over the House. More uncertainty there. And then also, my feeling is a lot of the earnings boost, this is a great year for earnings. No one argues with that. But the tax cut is front loaded, which means that the write-offs on capital equipment are going to accrue to 2018 and not nearly as much in 2019. I think those estimates are going to be brought down. So those three factors are going to pretty much stall out much of a increase, I think, that we hope for the next 6 months.
A very cautious sounding Jeremy Siegel. Thank you.
Thank you.
Nice to see you from Wharton today. And thank you all for watching Trading Nation. I'm Sara Eisen. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.